Ever clicked on buy and got the worse price than expected? That's not bad luck. That's just bad selection of order type. Let's fix that in the next 5 minutes. Hi, I am Pranav K, an NISM-certified trader and trainer and your buddy at Stockshaala by Kotak Securities. Today, we'll talk about something very simple but important while entering your trades. That is market orders versus limit orders. And getting this right can just save your trade. So, what are these orders really? Let's start with the basics. A market order. Whenever you choose a market order, it is like saying, get me in now at any best price possible. Whereas a limit order says, get me in now but only at the price that I have specified. Market order equals speed, limit order equals control. Simple, right? But here where it gets interesting. When to use market orders versus when to use limit orders. So let's start with the first one, using market orders. You've got a strong breakout along with volume confirmation and you want to enter the trade no matter what. You're okay with the small slippage that can occur, and the liquidity is also really good because you're trading in scripts like Nifty or Bank Nifty. That is exactly when you're going to use market orders so that your entry is confirmed. Think of it like booking a cab in peak hours. It's all about getting the cab at the right time rather than bargaining the price with the driver. But if you use it in illiquid stocks or during volatile times, be ready for surprises because you're going to face huge slippages. Illiquid stocks are stocks which has fewer buyers or sellers, which means entering into the stock or exiting the stock might be difficult than normal. Now let's talk about using limit orders. You use limit orders when you want to enter the stock at a specific price or when there is a pullback or a retest. And worst case scenario, you're okay if the trade does not take place. That is when you're going to use limit orders. So these are the situations where you're going to use a limit order for entering. Using a limit order is like asking your friend to go and buy tomatoes, but you're going to put a restriction that he can buy it only if the price of tomatoes is 100 rupees per kg. If it is beyond 100 rupees, then he will not buy it. Limit orders give you control, but sometimes the trades take off without you. This is the classic test of FOMO versus patience. Here's a rookie mistake by many traders. The mistake is that once they set a limit order, if the price starts moving up without triggering that specific limit trade, then first thing they do is panic. When they panic, they delete that limit order and enter into a market order at a higher price. This is not following the setup, but rather this is emotions. And this should be avoided at all costs. Instead, wait for the new setup and enter into a limit order once again. Your entry trigger is like a proposal. You either go down on one knee or you don't. Whether it is limit order or a market order, it has to be planned beforehand, not when the candle is being formed. Here are 4 simple entry rules that I use personally. Number 1, if it's a breakout, then go for a market order if you have confirmation along with volume. Number 2, if it's a retest entry, then go for a limit order. Number 3, if there is any volatility because of news, then make sure that you are not going to enter until you are a very experienced trader. Number 4, if there is low volume, then try to avoid market order and only stick to limit orders. Always calculate your stop loss as well as risk to reward ratios while choosing your execution types. If you are choosing market orders, then remember, then there might be 0.1% to 0.5% slippage while entering the orders. So let's wrap it up with a quick recap. Market orders give you speed, but they do not give you control. Whereas limit orders give you control, but they do not guarantee your trade execution. Choose your execution type based on the type of setup you have, the liquidity, the risk appetite, as well as the mental strength to wait. Don't just click on buy, think like a sniper, not a shotgun. Entries don't need to be perfect, but they just have to be planned. So make sure the next time you're taking an entry, it is planned and not an impulsive decision. In the next upcoming videos, we are also going to discuss about exits as well as stop losses. You're watching Stockshaala by Kotak Securities, and if you like this video, go ahead and share it with your friends. I am Pranav K signing off, and I'm going to see you in the next video.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.